So, hello, my colleagues in Business 365. What I'd like to do is just do a introductory video here for Chapter 11, just to give you an idea of where we're going to start. So, as you know, we skipped chapters 1 to 10. That was covered in Business 330. So, this is a follow-on to those chapters, okay? So, the first thing I want to do is go through, they put a lot of nice videos in the e-text, as you can see. This is the e-text which you all have access to. So what I'd like to do is run this video, okay?
By now, you've learned the basic capital budgeting techniques that firms use to analyze whether a particular investment creates value for shareholders. Before managers can calculate an investment's payback period, its NPV, or its IRR, they first have to have estimates of the present and future cash flows that they expect the investment to generate. This chapter's focus is on those cash flow estimates. A few key principles are important when thinking about how to estimate an investment project's cash flows. The first principle is that the focus should always be on incremental cash flows. That's just the difference between the cash flows that the firm will receive or pay if they invest and the cash flows that they will receive or pay if they don't invest. For example, suppose a few years after you finish your degree, you start thinking about going to grad school. Of course, there are non-financial reasons to further your education, but suppose you want to calculate the NPV of the investment you make if you go back to school. What are the incremental cash flows associated with that investment? An obvious one is the tuition you'll pay, as well as fees and other expenses like books. If you make more money with a graduate degree, the increase in your income after graduate school is an incremental cash flow. A less obvious incremental cash flow is an opportunity cost. You'll give up the opportunity to earn your present salary if you quit working and go back to school, and that lost income is an incremental cost of your schooling. You might think that the cost of room and board at school is another incremental cash flow, but it probably isn't. After all, whether you continue working or whether you go back to school, you'll have to have a place to live and you'll have to eat, so those costs aren't really incremental. The second principle is that cash flows should always be calculated on an after-tax basis. Remember, the goal of the analysis is to determine whether an investment creates value for shareholders, but the shareholders can only lay claim to the cash flows that remain after the firm pays taxes. In this chapter's examples, you'll see that we often use a 40% tax rate to arrive at after-tax cash flows. It turns out that just after the book went to the printer, Congress passed a new tax bill that dramatically cut the corporate tax rate to 21%. It's an interesting exercise to rework the examples in the text using that lower tax rate to see what impact it has on after-tax cash flows. Of course, cash flow projections will be different for every single investment, but there are some common cash flow patterns that you'll see over and over again. First, most investments require an outlay of cash at the beginning, which we call the initial investment. Second, once a firm makes an investment, it produces operating cash flows in future years, which might include incremental revenues or cost savings. In calculating operating cash flows, watch out for non-cash expenses like depreciation. They're important because they affect the taxes that firms pay, but they don't involve direct outlays of cash. Third, although some investment projects can last almost indefinitely, most of them have a finite life. When a firm shuts down an investment project, they sometimes recover some additional cash, which we call the terminal cash flow. So if you're trying to put together the cash flow estimates for an investment project, it may help to organize your thoughts around those three components: the initial investment, operating cash flows, and the terminal cash flow. There's one final observation I want to make before wrapping up this video. You'll notice in our examples, we never deduct interest expense as a cash outflow. Of course, we recognize that if firms borrow money, they have to pay interest, and they have to make those interest payments in cash. But in our capital budgeting analysis, we want to focus exclusively on the merits of the investment itself and not on where the money to finance that investment came from. In other words, we want to focus on the investment decision and not the financing decision. If you like, you can think about the examples in this chapter as pertaining to a company that is financed entirely with equity, so there is no interest expense. We'll address the financing decision later on.
Okay, so that was a interesting introductory video for this chapter. Okay. All right, so let's just go into this a little bit now, further now. Um, so in your and it's interesting, you notice how they look at it on a personal level, and the I guess the key word really here is your professional life, right? In your professional life, you need to understand capital budgeting cash flows to provide revenue, cost, depreciation, and tax data for use both in monitoring existing projects and in developing cash flows for proposed investment projects. You need to understand capital budgeting cash flows to maintain and facilitate the retrieval of cash flow data for both completed and existing projects. You need to understand capital budgeting cash flows so you will know which cash flows are relevant in making decisions about proposals for acquiring additional production facilities, for new marketing programs, for new products, and for the expansion of existing product lines, And basically, you need to understand capital budgeting. You notice the words here, all the common words in each little blurb. Capital budgeting cash flows, right? So that you can make revenue and cost estimates for proposals, for new marketing programs, for new products, and for the expansion of existing product lines, operations, capital. Again, once again, you'll notice here capital budgeting, cash flows. All right, and another thing right here in your personal life. All right, we'll make that a different color. You are not mandated to provide financial statements prepared using generally accepted accounting principles, so you naturally focus on cash flows. When considering a major outflow of funds in your personal life, of course, purchase of a house, funding of a college education, you can project the associated cash flows and use these estimates to determine the value and affordability of the assets and any other associated future outlays. Okay, so they talk about Molson's here. You know, everyone probably knows who Molson is, the brewing company. So in late 2015, the Denver-based brewing company announced that it would acquire the remaining 58% ownership stake it did not already own in Miller Coors, a joint venture created in 2008 between Molson Coors and SAB Miller. Taking full ownership of the joint venture would give Molson Coors complete control of the Miller brand outside the United States, as well as brands controlled by the joint venture within the United States. Molson agreed to pay $12 billion for the acquisition, with a combination of cash on hand plus additional funds raised by issuing new debt, which is bonds, right? Issuing new debt, which would be bonds, and having a stock IPO. Okay. All right. So what justified the deal's $12 billion price tag? According to Molson Coors senior management, the acquisition would create billions in incremental revenue over time, $250 million per year for 15 years, in incremental tax savings worth $2.4 billion in present value terms, and at least $200 million per year in incremental cost savings achieved by making improvements to the company's procurement processes and implementing other operational enhancements. Okay. All right. So we're about 10 minutes into this. I will pick this up in part 2 of this video. Okay. And we'll pick up on this cause discussion right over here. All right. See everybody later. Be safe.